Welcome to this explainer. Whenever I think about how central banks operate, I always picture this massive, top-secret control room. Imagine standing in front of a giant dashboard, just completely covered in dials, levers, and flashing indicators. Every single time a switch is flipped in that room, the effects ripple out into the real world, literally changing how much it costs for you to buy a house, run a business, or even just buy your weekly groceries. It can seem incredibly abstract and complex from the outside, but today we're going to pull back the curtain and break down exactly how this economic engine is kept running smoothly.
So let's start with a really fundamental question. Who actually controls the money supply? Well, every country has one of these economic control rooms. And to demystify the mechanics of monetary policy today, we're going to use the State Bank of Pakistan, the SBP, as our primary case study. By looking at exactly how the SBP operates on a daily basis, we're going to understand the universal tools that almost all central banks use to steer their economies.
Here is the blueprint for our economic control room today. We'll start with the central bank's mission, look at traditional versus promotional functions, and then dive deep into their three primary tools: open market operations, the interest rate corridor, and reserve requirements. Let's jump right in.
Section 1. The Central Bank's Mission: Steering the Economic Machine. Okay, let's get into this first section to uncover the absolute prime objective of any central bank: stability. We really need to anchor ourselves with this definition. As laid out in the SBP Act of 1956, monetary policy is all about using specific instruments to influence interest rates and the money supply. And why do they do that? To keep overall prices and financial markets stable. The ultimate goal for the folks in the control room is to secure monetary stability and attain a fuller utilization of the economy's productive resources. The best way they can do that sustainably is simply by keeping inflation low and predictable.
But of course, it's never that simple, right? In practice, the operator is constantly striking a really delicate balance among multiple competing priorities. You can't just push one button without messing up something else. They have to keep inflation in check, absolutely, but they're also ensuring the payment system doesn't crash. They're fiercely protecting foreign exchange reserves, and they still have to make sure private investment doesn't dry up. It's an endless juggling act to keep the economic machine from running too hot, which sparks hyperinflation, or too cold, which triggers a recession.
Moving on to Section 2, Traditional versus Promotional Functions, the Operator's Duties. A modern central bank, especially in a developing nation, is wearing a lot of hats. On the traditional side, you've got the standard things you'd expect: issuing currency notes, regulating the system, acting as the lender of last resort when banks are in deep trouble, and secondary tasks like managing public debt. But there's also a massive promotional side. The SBP actively develops the economy through non-traditional roles. They're out there building financial frameworks, institutionalizing savings, and in Pakistan's unique case, playing a huge part in the Islamization of the banking system. So they aren't just mechanics, they're actively upgrading the engine while it's running.
Section 3, Tool 1, Open Market Operations, Managing the Liquidity Flow.
So how do they actually pull this off? Enter open market operations, or OMOs. This is the most frequent lever they pull in the control room. It's a tool used to either inject funds into or mop up funds from the banking system. They do this by buying or selling eligible securities, usually on a really short-term basis. We're talking tenors of just 7 to 14 days. Think of OMOs like the operator literally injecting vital fuel into a dry economic system so banks can lend, or aggressively mopping up spills when there's excess unwanted cash just sloshing around.
What's really cool here is the beautifully simple binary contrast. When banks are short on cash, the central bank uses an OMO injection, specifically a reverse repo. The SBP essentially lends funds to banks against eligible collateral, like government securities, to fix that shortage. But if banks have way too much cash, what's called a long market position, the central bank performs an OMO mop-up. They sell market treasury bills, or MTBs, pulling that surplus cash right out of the system. It is highly precise, daily fine-tuning.
To be exact, the central bank actually utilizes 4 specific types of OMOs to manage this liquidity. We have the injections and mop-ups we just talked about, plus outright long-term sales or purchases. But take a look at that 4th type. Remember those promotional functions from earlier? The SBP uses a tool called Buy Muwajjal. This is a Sharia-compliant tool specifically designed to manage liquidity within the Islamic banking system, using Government of Pakistan Ijara Sukuk as the eligible security. It perfectly illustrates how these macroeconomic tools are adapted to fit the specific structural needs of a country.
Section 4, Tool 2, the Interest Rate Corridor, Setting the Speed Limits.
Now let's see how they build a literal financial corridor to keep everything in check. The central bank strictly bounds overnight market interest rates within a highly controlled range. Right in the middle, you have the target policy rate. Above that is the ceiling, the SBP reverse repo rate, which is currently set at 50 basis points, or 0.5% above the target. That's what banks pay to borrow when they are in a pinch. Below the target is the floor, the SBP repo rate, set at 150 basis points below the target. That's what banks get for parking extra funds overnight. Together, boom, you have a 200 basis point corridor that market rates are forced to stay inside.
And nestled right there in the center of that corridor is arguably the most important number in the entire economy. The SBP target policy rate unambiguously signals the central bank stance. Why this matters to you is pretty simple. This single target rate is the ultimate signal. When the central bank hikes this rate, they are aggressively trying to cool down inflation, which means the interest rates on your personal loans, your mortgages, and your business lines of credit go up. When they lower it, they're hitting the gas to stimulate growth, making it cheaper for you to borrow and spend.
Finally, Section 5. Tool 3, Reserve Requirements, the Safety Buffer.
Unlike those OMOs, which are happening dynamically every single day, this final tool relies on strict mathematical rules to ensure banks maintain a safe baseline of liquidity no matter what. The Cash Reserve Requirement, or CRR, is a specific percentage of a bank's total liabilities, meaning the money depositors have trusted them with, that must be held at the central bank. Under Section 36 of the SBP Act, this rule forces all commercial, microfinance, and Islamic banks to lock away a chunk of their cash with the SBP. And a really critical detail here, it is unremunerated. That means the SBP does not pay the banks a single dime of interest on these required reserves. It is purely a safety buffer.
So, what's the magic number? Well, currently, banks have to maintain an average CRR of exactly 5.0% of their total demand liabilities. And they calculate this as a biweekly average during what they call the reserve maintenance period.
But, as we know, day-to-day banking operations are wildly volatile. A bank might see a massive outflow of cash on a Tuesday and then a huge influx of deposits on a Wednesday. Because of that, while the average over the period has to hit that 5% mark, there is a strict daily minimum requirement of 3.0%. A bank cannot let its reserves dip below this 3% floor on any single day under any circumstances. It's an absolute hard stop to guarantee systemic safety.
The really crucial takeaway here is that this isn't just some blunt instrument, it's heavily tailored. For instance, time liabilities, which are deposits locked in for over a year, are completely exempt from cash reserves, which encourages long-term saving. Development financial institutions, or DFIs, only have to maintain a 1% CRR. And when you look at foreign currency deposits, the rules get even stricter, requiring 5% cash plus an additional 15% special cash reserve. The central bank applies these highly specific ratios to maintain absolute stability across very different types of institutions and currencies.
So, we've looked at the dials, the daily OMO injections, that rigid 200 basis point interest rate corridor, and those unyielding 5% cash reserve safety buffers. It's an incredibly sophisticated system designed for absolute precision control. But as we wrap up this explainer, I want to leave you with a provocative thought. If the control room has all of these precise, historically proven tools to balance out inflation and growth, what happens when the economic machine faces a truly unprecedented crisis? What happens during a global shock where literally no existing lever, floor or ceiling was designed to fix the underlying problem? How does central banks innovate when the entire machine threatens to break down? Keep that in mind the next time you hear about an interest rate hike on the news. Thanks for joining me on this explainer, and keep learning.